Most people imagine sanctions as a blunt instrument. A country is sanctioned, factories shut down, people lose jobs, GDP collapses, and the economy breaks under pressure. This mental model comes from how we think about physical war. Hit hard enough, and the structure falls. But modern financial sanctions do not work like bombs. In most cases, nothing breaks on day one. Shops still open. Workers still get paid. The lights stay on. The economy appears to function. That is precisely why sanctions are often misunderstood and underestimated. The real power of sanctions is not destruction, but distortion. They do not aim to collapse an economy overnight. They aim to quietly rewire how that economy behaves, what choices firms can make, what risks banks are willing to take, and how households store value and plan for the future. Sanctions operate less like a blockade and more like a set of invisible constraints that bend incentives over time. The damage is gradual, indirect, and behavioral. This is why sanctioned economies often survive longer than expected. GDP figures may dip, but not implode. Industrial output may stabilize. Governments point to resilience and adaptation. Yet underneath these surface indicators, the internal logic of the economy has changed. Prices stop reflecting productivity. Exchange rates stop reflecting trade balances. Investment stops flowing to its most efficient uses. Money still exists, but moves differently, more cautiously, more expensively, and through narrower channels. To understand this, it helps to abandon the idea that an economy is just a collection of factories and workers. A modern economy is a network, currencies, payment systems, credit relationships, insurance contracts, logistics chains, and trust. Sanctions target the network, not the nodes. They make connections unreliable. They introduce friction where there was flow. They force actors to behave defensively rather than optimally. The first illusion sanctions break is the idea that economic health equals output. A country can still produce oil, steel, food, or software under sanctions. What changes is how easily those outputs can be sold, financed, insured, transported, and reinvested. Each added constraint does not stop activity. It reshapes it. Firms shorten planning horizons. Banks hoard liquidity. Importers overstock critical goods. Exporters accept worse terms just to get paid. None of this looks like collapse, but all of it reduces long-term efficiency. Another misconception is that sanctions work primarily through prohibition. You cannot sell this, you cannot buy that. In reality, the most powerful sanctions rarely rely on explicit bans alone. They rely on uncertainty. When banks are unsure whether a transaction might violate a rule, they avoid it altogether. When insurers fear secondary sanctions, they withdraw coverage. When logistics firms cannot verify compliance down the chain, they raise prices or exit. The chilling effect spreads far beyond the letter of the law. This is why sanctions often hurt private actors more quickly than the state. Governments can mandate behavior. They can force banks to lend cap prices or redirect trade. Private firms, by contrast, must manage risk to survive. When payment channels narrow and counterparties become risky, firms adapt by pulling back, not by pushing forward. Investment slows not because it is illegal, but because it becomes unpredictable. At the household level, the effect is subtle but profound. People do not wake up to empty shelves. Instead, they notice that imported goods get steadily more expensive. Savings lose value faster than expected. Foreign travel becomes complicated. Holding local currency feels riskier. These micro-level adjustments aggregate into macro behavior. Higher demand for foreign cash, gold, or durable goods. Shorter-term consumption decisions. Declining trust in financial institutions. None of this requires panic. It only requires repeated small signals that the system is less reliable than before. What makes sanctions especially effective as a financial weapon is that they externalize enforcement. The sanctioning country does not need to police every transaction. Global finance does that automatically. Because key currencies, clearing systems, and correspondent banks sit within a small number of jurisdictions, access becomes conditional. The threat of losing that access is often enough. Compliance emerges not from force, but from fear of exclusion. This creates an asymmetry. The sanctioning side incurs relatively low ongoing cost, while the sanctioned economy pays continuously through higher transaction costs, worse financing terms, and constrained choices. Over time, these costs compound. Projects that would have been profitable without sanctions become marginal or unviable. Technologies that require imported components are delayed or abandoned. Productivity growth slows, not because people forget how to work, but because the economic environment punishes complexity. Crucially, sanctions also change who thrives. In distorted systems, scale and political connections matter more than efficiency. Firms with access to state backing, alternative payment channels, or privileged licenses gain advantage. Smaller, more productive firms struggle. This reshapes the structure of the economy itself, concentrating power and reducing competition. Again, nothing explodes, but the economy becomes less dynamic, less innovative, and more brittle. Seen this way, sanctions are not a test of endurance, but a test of adaptation. The question is not will the economy collapse, but what kind of economy will emerge under constraint? History shows that sanctioned states often adapt, but adaptation comes with trade-offs. They substitute suppliers, accept lower quality inputs, reroute trade through intermediaries, and rely more heavily on domestic finance. Each workaround solves an immediate problem while embedding long-term inefficiencies. This is why sanctions rarely produce immediate political change. Their logic is slower. They aim to reshape incentives across millions of decisions. What currency to hold, where to invest, how much risk to take, whether to expand or conserve. Over time, these decisions accumulate into lower growth, higher volatility, and reduced strategic flexibility. The economy still functions, but it functions differently. In the next part, we will zoom in on the first major channel through which this behavioral rewiring happens, the exchange rate, not as a number on a screen, but as a pressure system that quietly forces households, firms, and governments to adjust their behavior long before anything visibly breaks. At first glance, the exchange rate looks like a simple price, how much one currency is worth in terms of another. When a sanctioned country's currency falls, it is often described as a verdict on economic weakness, corruption, or poor policy. But under sanctions, exchange rates stop being a clean signal of productivity or trade fundamentals. They become a pressure mechanism, one that quietly transmits constraints through every layer of the economy. The moment sanctions restrict access to major payment systems, correspondent banking, or reserve assets, the currency is pulled into a trap. Foreign demand for the currency drops not because exports vanish overnight, but because the currency becomes harder to use. Even willing buyers face higher friction. Fewer banks will clear transactions, fewer insurers will cover trade, and fewer intermediaries will touch settlement. As usability declines, so does demand. The exchange rate adjusts accordingly. This adjustment is often abrupt at first. Capital outflows accelerate as investors reprice risk. Residents rush to convert savings into foreign currency or hard assets. The central bank intervenes, spending reserves or imposing controls. Headlines focus on the fall itself, but the deeper effect lies in what follows. Once the currency is perceived as fragile, every economic actor begins to behave as if depreciation is a default future state. For households, this changes saving behavior. Holding local currency no longer feels neutral. It feels like a bet and not a good one. People shorten time horizons. They spend faster, buy durable goods earlier, or seek foreign cash through informal channels. This is not driven by panic, but by rational adjustment to repeated signals. Even mild depreciation, when persistent, teaches people that money is safer in things than accounts. For firms, the exchange rate becomes a planning hazard. Importers face rising costs that are disconnected from global prices. A machine that costs the same in dollars becomes more expensive in local terms month after month. Exporters, in theory, benefit from a weaker currency. In practice, sanctions blunt this advantage. Payment delays, compliance costs, and settlement risk eat into margins. What looks like a competitive boost on paper turns into a working capital problem in reality. This is where imported inflation enters. Depreciation under sanctions is not just a macro statistic. It is a behavioral tax. Every imported input energy technology, spare parts, pharmaceuticals, software licenses becomes more expensive. Firms respond by substituting lower quality inputs, cutting maintenance, or raising prices. Consumers respond by downgrading consumption or absorbing higher costs. Inflation becomes embedded not through excess demand, but through constrained supply and defensive pricing. Governments often respond with controls, fixing the exchange rate, restricting currency purchases, mandating export conversions, or rationing imports. These measures can stabilize the headline rate temporarily, but they deepen the behavioral distortion. A fixed rate creates a parallel market. Restrictions create incentives to misinvoice trade or hoard foreign currency. Over time, the official rate loses informational value, and economic actors plan around the unofficial one instead. This duality is a key feature of the currency trap. The exchange rate no longer coordinates the economy efficiently. It fragments it. Firms with privileged access to foreign currency operate under one reality. Everyone else operates under another. Decisions are no longer about productivity or comparative advantage, but about access. Who can get dollars, at what price, through which channel? Currency becomes a gatekeeper. Central banks, meanwhile, face impossible trade-offs. Raising interest rates to defend the currency can stabilize expectations, but at the cost of credit contraction. Lowering rates to support growth risks accelerating depreciation. Under sanctions, normal monetary transmission is broken. Policy signals are overwhelmed by external constraints. The central bank is managing scarcity, not smoothing cycles. Over time, the economy adapts to this environment. Dollarization increases, formally or informally. Contracts are indexed to foreign currency. Large purchases are priced in dollars, even if settled locally. This reduces currency risk for individual actors, but entrenches it systemically. The local currency becomes a transactional medium rather than a store of value. Once this shift occurs, reversing it is extremely difficult. What makes the currency channel such an effective financial weapon is its subtlety. No law forces people to abandon the currency. No decree orders firms to reprice in dollars. Behavior changes voluntarily, driven by incentives. Each individual decision is rational. Collectively, they lock the economy into a lower trust equilibrium where exchange rate stability matters more than growth, and access matters more than efficiency. Crucially, these effects persist even when the exchange rate appears to recover. A rebound does not restore trust. Economic actors remember volatility. They price in the risk of renewed restrictions. The currency carries a sanctioned premium, a discount, reflecting not current conditions, but the possibility of future exclusion. This premium raises the cost of capital across the economy long after the initial shock fades. In the next part, we will move from price to flow, from exchange rates to liquidity. Because under sanctions, the most damaging condition is not that money loses value, but that money exists and yet cannot move when and where it is needed. If exchange rates are the visible pressure gauge of sanctions, liquidity is the silent constraint that does the most damage over time. Liquidity is not about how much money exists in an economy. It is about whether that money can move, settle, and be transformed from deposits into loans, from assets into payments, from promises into cash. Under sanctions, liquidity does not disappear. It congeals. The first shock comes when assets are frozen or access to foreign reserves is restricted. On paper, a country may still own hundreds of billions in assets. In practice, those assets become unusable. They cannot be pledged, swapped, or mobilized to calm markets. This immediately changes how both domestic and foreign actors perceive risk. Trust in the system's backstop weakens, and liquidity becomes something to be hoarded, not circulated. Banks sit at the center of this process. Modern banking relies on confidence that short-term obligations can always be met through interbank markets, central bank facilities, or foreign funding. Sanctions sever or weaken these links. Correspondent accounts are closed. Cross-border credit lines are withdrawn. Even solvent banks become cautious because access to emergency liquidity is no longer guaranteed. This is where the difference between solvency and liquidity becomes critical. A firm or bank can be solvent assets exceed liabilities and still fail if it cannot meet payments on time. Under sanctions, this risk increases everywhere. Payments that once settled in hours take days or weeks. Documentation requirements multiply. Any delay raises a chance that funds are stuck mid-transaction. Faced with this, banks reduce exposure preemptively. Credit tightens not because interest rates alone rise, but because balance sheets become defensive. Banks shorten loan maturities. They demand more collateral. They favor state-linked or politically protected borrowers. Small and medium enterprises feel the squeeze first. Payroll financing becomes harder. Inventory cycles stretch. Investment plans are postponed or canceled. Again, nothing collapses but growth quietly bleeds out. For governments, the liquidity problem is even more complex. Fiscal operations depend on smooth financing, rolling over debt, paying contractors, importing critical goods. When access to foreign markets is cut and domestic banks are constrained, the state turns inward. It pressures banks to absorb government debt. It relies more heavily on central bank financing. This can stabilize the system in the short run, but it further concentrates risk within the domestic financial sector. This concentration creates feedback loops. As banks hold more government debt, their balance sheets become more sensitive to fiscal stress. As the state relies more on banks, it becomes less willing to let them fail. The result is a form of financial captivity. Liquidity flows where the state needs it most, not where it is most productive. Private investment is crowded out not by law, but by necessity. International trade exposes the liquidity weapon most clearly. A company may have buyers abroad and goods ready to ship, yet still be unable to complete a transaction. Without reliable letters of credit, insurance, or settlement banks, trade becomes a cash business. Prepayment is demanded. Discounts widen. Intermediaries take larger cuts. Each workaround increases working capital needs and reduces margins. For importers, the problem is inverted. They must secure foreign currency up front, often through unofficial channels, and pay higher fees to ensure delivery. Delays tie up capital. Uncertainty forces over-ordering of critical inputs. Warehouses fill not because demand is high, but because liquidity risk makes just-in-time logistics impossible. Capital that could have funded expansion is locked in buffers. At the household level, liquidity stress manifests as fragility. Wages may be paid, but credit dries up. Mortgages become rare or prohibitively expensive. Consumer lending contracts. Families rely more on cash, informal credit, or employer advances. The financial system still exists, but it no longer smooths shocks. It transmits them. What makes liquidity such a powerful sanction channel is that it operates below political visibility. Governments can claim stability as long as banks remain open and payments eventually clear. Yet the economy's ability to respond to opportunities and shocks is degraded. A system with poor liquidity is brittle. It cannot easily redirect resources, absorb losses, or finance innovation. Over time, actors adapt. Alternative payment systems emerge. Regional banks replace global ones. Bilateral clearing arrangements substitute for open markets. These adaptations restore some flow, but at a cost. Liquidity becomes segmented and expensive. The economy functions through narrower pipes, with less redundancy and more points of failure. Crucially, liquidity sanctions reshape behavior permanently. Once firms learn that financing can vanish overnight, they prioritize survival over expansion. Once banks learn that external support is uncertain, they optimize for safety over efficiency. Once households learn that credit is unreliable, they avoid leverage altogether. These are rational responses, and they are exactly what sanctions are designed to induce. In the final part, we will follow this logic one step further, into the physical world of supply chains. Because when currency and liquidity constraints accumulate, they do not just change prices and finance. They force the real economy to reorganize itself not around efficiency, but around endurance. When currency pressure and liquidity constraints persist, they eventually spill out of the financial system and into the physical economy. This is where supply chains come in. Sanctions rarely aim to stop production outright. Instead, they make production harder to sustain by attacking the invisible scaffolding that modern supply chains depend on: predictable payments, insurance, compliance, clarity, and timing. What breaks is not the chain itself, but the logic that once made it efficient. At first, the disruption looks manageable. A supplier is replaced. A route is rerouted. A component is sourced through an intermediary. Governments point to continued output as proof that sanctions have failed. But this misses the point. Supply chains under sanctions do not collapse. They thicken. Every link gains friction, cost, and delay. The chain still works, just badly. One of the earliest changes is in logistics. Shipping firms raise premiums or withdraw entirely when insurance coverage becomes uncertain. Ports demand additional documentation. Freight is diverted through longer routes to avoid sanctioned jurisdictions. Each adjustment adds time and cost. Inventories that once turned quickly now sit longer in transit or storage. Firms respond by holding more stock, tying up capital and reducing flexibility. Compliance becomes supply chain cost in itself. Even goods that are technically legal require extensive verification. Companies must prove not only what they ship, but who touched it, financed it, insured it, and transported it. The burden does not fall evenly. Large firms with compliance departments adapt. Smaller firms exit international markets altogether. Trade becomes more concentrated, less competitive, and more political. Technology supply chains are especially sensitive. Advanced manufacturing depends on specialized components, software updates, maintenance contracts, and technical support. When access to these inputs becomes uncertain, firms face a choice: slow down, substitute, or redesign. Substitution often means using older or less efficient technology. Redesign takes time and money. Both reduce productivity growth long before they reduce output. Energy and commodities tell a similar story. Sanctioned producers often continue to sell, but at a discount. Buyers demand price concessions to compensate for risk and inconvenience. Transport costs rise. Payment terms worsen. The producer's revenue falls even if volumes hold. Over time, investment in capacity declines. Maintenance is deferred. The future is quietly mortgaged to keep the present running. These pressures force adaptation. But adaptation is not free. Trade routes reorient toward fewer partners. Dependence on intermediaries increases. Informal or opaque arrangements proliferate. Each workaround solves an immediate bottleneck while embedding long-term inefficiencies. The economy becomes more inward-looking, more redundant, and less innovative. Importantly, this reorganization changes incentives. Firms optimize for reliability over efficiency. They choose suppliers who are politically safe rather than technically superior. They prioritize relationships that can survive disruption rather than those that minimize cost. This is rational under constraint, and it permanently reshapes industrial structure. At the national level, policymakers often respond by pushing for self-sufficiency. Strategic sectors are identified. Domestic substitutes are subsidized. Local production is celebrated. Some of this succeeds. Much of it is expensive. Autarky trades resilience against efficiency. The result is an economy that can endure pressure, but struggles to grow quickly or integrate at the technological frontier. None of this looks like sudden failure. Factories still operate. Goods still move. Trade still happens. This is why sanctions are often judged ineffective in the short run. But the cumulative effect is unmistakable. Over years, the economy drifts away from global best practices. Productivity gaps widen. Innovation slows. Choices narrow. This is a hidden financial weapon inside sanctions. They do not destroy capacity. They redirect behavior. Through exchange rates, liquidity, and supply chains, sanctions alter how millions of decisions are made every day. They reward caution over ambition, access over efficiency, survival over growth. The economy adapts, but into a different shape. By the time the full cost is visible in growth data or living standards, the behavioral changes are already entrenched. Even if sanctions are lifted, trust does not return overnight. Supply chains do not instantly rewire themselves back to efficiency. Financial actors remember the risk of exclusion. They price it in. Sanctions and are not about collapse. They are about control. They reshape the environment so that certain behaviors become too costly, too risky, or too slow to sustain. The economy keeps moving just along paths it would never have chosen freely.